Let's talk about this private to public transition more because, personally, it's the most exciting intersection that I am seeing. In my day job as a VC, now seeing companies and startups which have the potential to go public. But you famously go on saying that, we don't back any loss making companies. So then, which are the interesting companies and growth sectors that you are seeing opportunities in? And what are you excited about?
So see, this whole evolution of private and unlisted and pre-IPO started with, obviously, what happened was in 2015, 16, 17, 18, the public markets were not very buoyant. And therefore, the companies who needed capital, they went the unlisted fundraising route.
Yeah.
And they were offering it at a decent valuation. And when those companies came off a listing, which was in 2023, 24 and 25, the public markets were very buoyant. So, you bought it very cheap and you were able to sell it very high. And I think that lure of near-term gains always brings in more and more people into it. There are some startups which have done phenomenally well and money has gone up by 50, 100, 200 times in the likes of Nykaa and Zomato, and the early investors have made a lot of money there. And I think that also leads a lot of, I would say, not greed, but interest from investors. Obviously, this whole concept of family office has picked up pace last 3-4 years. Entrepreneurs in India, families have huge surplus funds which they are willing to back. And there's this natural tendency to do something different or something exotic. And I think that is also where this whole lure of unlisted or private companies have come in. My view is that yes, there is opportunity, but what happens is that we only remember the ones who have been successful. We don't even talk about, maybe for one very successful startup or a venture backed company which has become 50, 100x, there would be 99% which would have just become zero. We forget that. So I think there is definitely opportunity. There are a lot of entrepreneurs. But few things we have to remember. One is it's a very specialized, I would say investing. So you mentioned about profit-making companies. Our expertise is in analyzing listed companies, and we have a traditional way of analyzing it. So we only back profit-making companies. We are willing to give capital to companies to grow, not to burn. We are very focused on companies as far as their capital efficiency and capital allocation is concerned. So return on capital employed becomes very, very important for us. So I think that is the whole framework in our listed space. What we said is that there's an opportunity on the private side. And family offices and individuals are jumping directly.
Yeah.
They don't have the wherewithal, most of them, to analyze those companies. They don't have the legal framework of having a shareholder agreement and SPA and all done. Can we be the interface and ensure that their capital, which they want to invest in this segment, is invested in a professional way? And that was the logic why we launched a 2,400 crore fund last August. It will focus exactly on what we do in the public markets, which is companies which will get listed over the next 1 to 3 years. Good entrepreneurs, profit making, who need capital to grow in the interim till they become public, and who have decent return ratios. There is opportunity even on the tech side or on startup side, but we are not capable of doing it because we don't have the expertise. Maybe there are some private equity funds who would be in a better position to do it. Again, on the private side, one has to be very careful. On public markets, if you go wrong, there is an exit. On private markets, you will be stuck with it. So, your due diligence process in the private markets has to be more than the public markets. But unfortunately, the investment bankers come and they rattle names that ye invest kar raha hai, wo invest kar raha hai, and everyone piles up. So I think we have to be a little bit careful.
Yeah, but definitely. There's so much optionality and bankers get all sorts of deals to you. A lot of them are very, very richly valued that, you wouldn't do in the public markets.
In public or private, you should know what not to do.
Let's talk about that.
Yeah.
What are the things that you will absolutely avoid or advise people?
So from our side, obviously, richly valued companies which don't justify, the valuation they are asking for, loss-making companies who need capital to burn, not to grow. You just can't, on the basis of a presentation with very lofty future projection and nothing on the ground with no revenue, Those are like, you're just trying to pick a needle in a haystack, because you don't know, maybe 1 out of 100, 200 companies might become successful. So, you have to be very clear what your risk profile is. If you are willing to basically spray and pray, then it's fine. Then you invest in 100 companies, maybe, 1 or 2 of them might become successful. But I think greed is definitely something which lures investors to make losses. And the second thing is, you should do what you and your style is comfortable with. Just don't do it because someone else or your friend or some marquee investor is doing it. Everyone will have a different risk profile.
Yeah, but I've seen so many people and even bankers come to you and say that, Mr. Sunil Singhania has invested in this deal.
Their perspective might be very different,
Yeah.
right? If a very large investor who has a 10,000 crore net worth invests 10 crore rupees, it's fine. But based on that 10 crore, someone who has 200 crores of net worth cannot invest 10 crores, right?
Yeah.
Now, so there is a different perspective to every investor's decision making.
Absolutely. That's a good framework to keep in mind. But also, on the private side, because one in the power law and like how it applies to private markets is that, VCs are very comfortable with, 9 out of 10 companies dying as long as they get their one outlier. But in public markets, we are so used to making at least most of the companies win or, betting on their company's growth. We don't want that mortality rate in our portfolio, right? So how do you bridge this balance? Because this is also a mindset balance that you have to bring into the picture.
So as far as our private equity is concerned, we are not giving capital to burn. So mortality is not going to be there.
So you don't expect any mortality?
There won't be any mortality. It is possible that our perspective on the growth of the company might differ a little bit. Some companies might grow faster than what we expect. Some companies might grow slower than what we expect. So our view is that returns might differ. But because we are following a very strict disciplined approach of backing only established companies, and we are investing 100, 150 crores in one company, so typically that company itself will be worth at least 1,000, 2,000, 3,000 crores. So these are not very teeny mini companies with history of 4, 5, 7, 10 years of operational experience. So I don't think there will be mortality in companies becoming zero. What can happen is some companies might be fantastic in terms of return. Some company might not be what one expected when you invested. So I think we are fine. Obviously, we are very choosy, and that's why we are very slow. So in the last 8, 9 months, we have done only 5 investments. But we have already communicated to our investors that we'll invest over 2 years, and we are on track to do it. Now, I think a lot of companies are also appreciating the fact that we bring a lot of value on the table in terms of guiding them, in terms of also, helping them in their journey towards becoming listed. Little bit of, I would say, advantage they get also is that when we invest, there's a normal, I would say, at least a lot of investors have comfort that, someone would have done their work properly. So I think that also helps them. In fact, one of the companies which we invested will go public at 2-3x of our investable price very, very soon. So in 1 year, it will be more than 2-3x of what we invested in. So I think it's working and we are not in a hurry.
And the risk also on the private side tends to be that sometimes these IPOs get delayed, right?
Yeah.
So we've seen so many companies and promoters talk about getting listed a certain year and then
you should always be very clear that if a company is expected to get listed in 2 years, it might take 3-4 years. And
is that the framework you entered?
We have a 6.5-year lock-in fund. So we are pretty okay. The other thing is, as long as the business is growing, value is being added.
Yeah.
So whether the IPO comes in 1 year or 3 years, it's only a comfort, Only thing is, if it gets listed, you have an exit option and you can rotate your capital.
Yeah.
If the listing gets delayed, then obviously that possibility of rotating the capital reduces to some extent.